The market looks strong. That is exactly why I think you need to be careful. The S&P 500 is touching all-time highs. Again, Bitcoin is running, dividend ETFs are quietly climbing, the headlines are getting calmer, the Strait of Hormuz is technically open, people are breathing easier, and that is usually the moment ordinary investors become most vulnerable. Not when everybody is openly panicking, not when fear is obvious, not when the market is already down 30% and the television is red all day long. The dangerous moment is when risk comes back dressed as reassurance. That is where we are, because the market is acting as if conflict no longer matters. Inflation is under control, policy risk is manageable, and every new technology story deserves a premium. I do not believe that. And when I do not believe the market's mood, I get slower, not faster. That is one of the oldest lessons I know. The crowd loses the most money, not by buying after a crash. It loses the most money by getting seduced right before one. That is why I want to say something as clearly as I can. Do not let all-time highs hypnotize you. An all-time high is not proof of safety. Sometimes it is proof that enthusiasm has outrun discipline. Sometimes it is proof that liquidity is still carrying prices higher, even while the structure underneath is getting weaker. And sometimes, worst of all, it is proof that the public is being lured back into speculation, right? As the smartest money is preparing for a different phase. That is the setup I think we are flirting with. Now, let me tell you what I am seeing. I am seeing a market that is celebrating price without fully respecting quality. I am seeing a market that is rewarding stories faster than it is rewarding earnings. I am seeing a market that is acting like war-driven inflation, shaky Fed policy, and fragile economic confidence can all simply be floated over because prices are higher this week than they were last week. That is not how risk works. Risk does not disappear. Because a chart is green, it accumulates while people are not looking. And I think the most important thing happening right now is not the headline rally. It is the return of the oldest and stupidest form of speculation story. Chasing this is what always happens near the dangerous end of an excited market cycle. People stop asking what a business earns. They stop asking how durable the balance sheet is. They stop asking whether margins can survive a harder environment. They stop asking whether they are paying a sensible price for future profits, and they begin asking only one question. Will somebody else buy this from me at a higher price? That is the entire disease. And when enough people start thinking that way, a market can look strong right before it becomes weak. We have seen this movie before. Back in the late 1090s, people were not wrong that the internet would change the world. They were wrong about price. That distinction matters so much. A technological revolution can be real and still be an awful investment if you buy it at the wrong time and at the wrong valuation. People forget that because they like stories with heroes and villains. The dot-com era gets retold as if the lesson was that the internet was fake. The internet was not fake. The timing was reckless, the pricing was reckless, the assumptions were reckless, and the public was not investing in businesses anymore. It was investing in names, momentum, and social proof. The internet was the excuse. FOMO was the engine. That is what created the crash. People were buying stocks because the stocks had gone up. That was enough. Then it got even dumber. Companies that had no real internet business at all started attaching .com to their identity because they understood that the market had stopped caring about substance. All that mattered was association. If you could attach yourself to the thing people were excited about, money would arrive. That is one of the clearest signs of a speculative market. Not that one good company gets loved too much, that the market starts rewarding costume changes, and this week we got a costume change. A shoe company decided it wanted to become an AI company, not because it had suddenly built a world-changing model, not because it had quietly developed some extraordinary new engine of profit, not because its cash flows transformed overnight, because it put the right two letters in the press release. AI, and the market rewarded it with a one-day move that looked more like a penny stock fever dream than a rational response to new value. That should bother you. Not because one ridiculous stock going vertical is the end of the world, because it tells you where the market's mind is. The crowd is once again rewarding narrative over numbers. That is the first red flag. I call it the costume signal. A market enters a dangerous phase when a company can change the clothes on its story and the public responds. As if the economics change too. That is not investing. That is a costume party with margin accounts. And if you think I am exaggerating, go back and study the market's ugliest collapses. They are always preceded by a stage where people stop distinguishing between a real business and a fashionable label. That is why I take a setup like this seriously. It tells me the market is no longer only pricing real winners. It is beginning to price the dream of winning. That is much more dangerous. Now let me give you the second red flag, because in some ways it is even worse. The loosening of day trading restrictions. Whenever a market is getting euphoric, there is a temptation to call anything that increases access democratic, progressive, or good for the little guy. Most of the time it is good for the toll collectors, not for the little guy. That is what I think is happening here when platforms make it easier for smaller accounts to day trade more actively. The platforms win first. They get the activity, they get the churn, they get the volume, they get the revenue. It does not matter whether the person on the other side of the screen actually builds wealth. The platform gets paid for participation, not for your success. That is what people keep forgetting. The casino does not need you to win, it needs you to keep playing. And when regulators remove barriers in a speculative market, people celebrate freedom while ignoring exposure. They think more ability to trade must mean more opportunity. Often it means more opportunity to destroy yourself faster. That is the second red flag. I call it the access trap of mature. Disciplined market does not need to entice weaker hands into faster speculation at the exact moment valuations are already stretched and story stocks are acting manic. That is the kind of thing you see late, not early. Because late in a cycle, everybody wants one more layer of fuel, one more group of buyers, one more burst of liquidity, one more retail wave willing to chase the thing that has already run too far. That is what scares me. The costume signal and the access trap arriving together tell me something very important. This is no longer just a healthy market rewarding good businesses. It is becoming a market where discipline is optional and excitement is being monetized. That can go on longer than people think, but it never ends cleanly. Now, I want to be careful here. I am not saying AI is fake. That would be as stupid as saying the internet was fake in 1999. AI is real. It will matter. It will change business models, workflows, labor markets, software economics, productivity patterns, and probably entire industries. That is not the issue. The issue is price. The issue is timing. The issue is what happens when the crowd starts paying today for a future that is still far from being evenly monetized. That is always where bubbles hide. They hide inside truths. The most dangerous bubbles are never built on obvious nonsense. They are built on real transformations being overcapitalized by impatient people. That is what happened in the late 1900s, and I think parts of that behavior are now reappearing in AI-adjacent areas. Good companies can still be dangerous if they are priced for perfection. That is the second lesson people keep forgetting. A real business with real earnings can still be a bad investment if you overpay badly enough. The market does not reward being right about a trend. If you are wrong about the price, you can be right about the future and still lose money in the meantime. That is one of the cruelest truths in markets and one of the least respected by people who have only known momentum. Now let us leave the red flags for a moment and talk about the broader environment, because this matters even more than the costume stock and the day. Trading deregulation. There are three large forces fighting underneath this market at the same time: war-driven, inflation, uncertain Fed policy, and shaky economic confidence. The reason the market feels so strange right now is because it is rallying while all three are still unresolved. That is not impossible, but it is unstable. Start with the Strait of Hormuz. People keep acting like because it is technically open, the problem is over. That is shallow thinking. The issue is not simply whether ships can pass today. The issue is whether the market trusts that passage enough to price oil, freight insurance, and long chain supply decisions as if the risk has genuinely disappeared. I do not think it does. And markets do not need a full closure to feel stress. Uncertainty alone is enough to keep cost elevated and behavior cautious. That matters because inflation does not care about headlines nearly as much as people think. If oil stays under pressure or volatile, if war spending continues, if supply frictions remain alive, that is enough to keep price pressure in the system, which means the Fed does not get the easy life people keep hoping for. Now we come to the second force, the Federal Reserve. This is where a lot of people start playing fantasy. They tell themselves the Fed will simply cut if things get bad and support the market like always, maybe. But every time the Fed cuts into an inflationary environment, it does not just help risk assets. It also weakens discipline. It tells the market again that policy can be bent toward avoiding pain. The more that message gets reinforced, the more people stretch, speculate, and overpay. That is exactly what I do not want to be doing near retirement age. I do not want to be dependent on the central bank choosing the perfect sequence of rate moves while a war-linked commodity shock sits in the background and market valuations already look rich. That is too many assumptions, too much faith, too much exposure to things outside my control. The third force is confidence. This one matters more than people think. A market can keep rising for a while on momentum, but if confidence underneath the economy weakens enough, the damage eventually reaches earnings. Companies do not live off vibes forever. They live off revenue, margins, demand, cash flow, and if consumers get squeezed harder by energy, necessities, and financing costs, the corporate layer does not stay untouched. That is where the lag lives. The public always sees the pressure late. Now this is where I want to say something directly to people near or in retirement. You cannot invest like a 28-year-old with a strong salary when you are 60, 65, or 70. You simply cannot. The later game is not about squeezing out the last bit of upside from every mania. It is about survival first, because survival gives you time, and time gives your good decisions the chance to work. That is why I am much more interested in discipline than excitement right now. People hear a warning like this and think the answer must be sell everything. Number that is not discipline either. That is panic. And panic destroys just as much wealth as greed does. You do not need to go all cash because the market feels frothy. You do need to know exactly what kind of market you are in. And I think this is a market where gamblers are getting pulled in and disciplined investors should be tightening standards. That means several things. First, emergency cash matters. I know people glaze over when I say it because it sounds boring compared with whatever AI name is up 80% this year. But emergency cash is what keeps you from selling assets at the worst possible time if life turns against you. The worst case scenario is never just the market drops. The worst case scenario is that the market drops, inflation stays sticky, your job or business income weakens, and you are forced to liquidate good assets at bad prices because you built no breathing room into your life. That is how people go from paper loss to permanent damage, not because the chart fell, because they had no margin. That is why I always say cash is not only return drag. It is optionality, it is emotional stability, it is the ability to survive a bad sequence without handing your future over to the market. Worst mood. Second, high interest debt has to go. This is not a glamorous point, but it matters more than almost everything else. If the environment turns uglier and you are paying double-digit interest while your assets are volatile, the debt becomes a predator. It hunts you in both directions. Up markets do not save you enough, and down markets punish you twice. That is why I would rather enter a frothy and uncertain market with less debt and more optionality than with a handful of speculative winners and a balance sheet that cannot take a punch. Third, broad market dollar cost averaging still makes sense. This is the part people usually misunderstand most. They think if I am warning about risk, I must also be saying to stop investing. Number, I am saying stop gambling. There is a difference. I still believe in broad ownership of productive businesses through simple broad ETFs over long periods of time. I still believe the S&P 500 remains one of the best long-term wealth machines ever created. I also believe that all-time highs by themselves are not a reason to stop buying. Markets hit highs all the time on the way to going higher over long stretches. What matters is how you buy and what role that buying plays in your larger system. If you are steadily dollar cost averaging into broad, low, cost-diversified funds and you have your emergency reserves and your debts handled, then you are not behaving like the crowd. You are behaving like an owner. That is exactly the distinction I care about. The gamblers are chasing shoe companies that rename themselves around AI. The owners are steadily acquiring productive exposure with risk controls and liquidity in place. Those are not the same species. One gets wealthy slowly, the other gets taught expensive lessons. Now, I want to talk about the worst case scenario because people hate thinking about it, and that is exactly why they should think about it. Worst case does not mean most likely. It means the scenario that can hurt you most if you are unprepared. And right now, the worst case is not subtle. The market rolls over from a speculative top. Oil stays elevated or turns higher again. Inflation firms back up. Consumers cut spending. Companies see earnings pressure. Hiring weakens. Layoffs begin. You lose income at the same time your living costs remain elevated and your portfolio is down. That is the kind of sequence that turns a careless investor into a forced seller. That is what I want you protected against, because if you are protected against that, then even if it does not happen, you still win. You have extra liquidity, less debt, more resilience, more dry powder, more freedom. That is not a bad outcome in a bull market. It is an excellent outcome in any market. This is one of the great secrets of wealth. The rich often get richer not because they predicted the future better, but because they built their lives so that bad scenarios did not force them into ruin. They had staying power. That is what most people lack. They want maximum returns without building staying power. That is backwards. Now let me say something about the market's current rally. A rally off uncertainty is not the same thing as a healthy advance. When I see rallies built on narrowing participation, weakening breadth, or speculative concentration, I do not feel reassured. I feel alerted. Because the market often does its best work at the surface right before it starts failing underneath. That does not mean this week is the top. It means the quality of the move matters more than the emotional comfort of the move. And right now I think too many people are using new highs as an excuse to drop their guard. That is not how I want to operate. I want to assume the environment is still fragile until proven otherwise. I want to assume conflict risk can return. I want to assume inflation pressure can stay stubborn. I want to assume policy mistakes are still possible. I want to assume that AI enthusiasm can overshoot rational pricing in a way that hurts late buyers. I want to assume that the public's new access to speculation is good for platforms and bad for discipline. That is the posture I trust, not fear preparedness. Now let me pull this all together. The real red flags this week were not just that stocks made highs, it was what else happened at the same time. A meaningless AI costume change got rewarded like a revolutionary business model. Speculation got easier for smaller accounts at exactly the wrong time. War-linked inflation risk did not disappear, but the market behaved as if it did. The Fed remains stuck between supporting growth and respecting inflation, and investors close to retirement are being tempted to forget that the late game is about preservation first. That is why I say do not be fooled. A market can look strongest at exactly the moment when behavior inside it is getting weakest. And that is what I think this market is starting to show. If you are disciplined now, you give yourself a huge edge. If you are greedy now, you may be volunteering to become the liquidity for somebody else's exit. I have no interest in being that person. So here is how I would summarize the moment. Keep your emergency fund real. Kill high-interest debt. Keep dollar cost averaging into broad productive exposure. Do not chase costume stocks. Do not let access to speculation seduce you into confusing activity with skill. Do not assume all-time highs mean safety. Do not assume the market is calm just because the headlines got cleaner for a few days. And above all, if you are in the later innings of life, remember what game you are playing. You are not trying to turn one great year into a legend. You are trying to preserve a lifetime of work, keep your options open, and stay in a position where no market mood can force you into permanent damage. That is what real discipline looks like. And in a market like this, discipline is not just a virtue, it is a moat.